morning, good afternoon, everyone. Welcome to our earnings call for the second quarter of FY19. Let me walk you through the headline numbers. Our Q2 revenues came at $328.5 million, up 2.7 quarter-on-quarter and 21.4% year-on-year. In constant currency, this translates into quarterly growth of 3.5%. We are pleased with our performance in Q2. This growth is driven by our digital services offering. Analytics, AI, and cognitive grew at 20+% quarter-on-quarter, and enterprise integration and mobility also grew at close to 25%. Last quarter, I had shared with you details on several industry tech analyst recognitions that we have received around digital technologies. I am happy that our quarterly numbers are corroborating our early mover advantage in these areas. What is really heartening is that our revenue growth in digital domains is pervasive and not restricted to select accounts. The widespread of penetration of these technologies across our client base is encouraging and bodes well for our future. Digital is now 37% of our revenue, up from 34% last quarter. I have earlier shared with you three pillars of our revenue growth strategy. 1, winning large deals. 2, opening marquee new logos. And 3rd, effective client mining. On Q2 results saw us delivering on all these three counts. Talking about large deals, in Q2 we inked a deal with a global pharma major to be their transformation partner as the client embraces IoT and smart manufacturing across its global manufacturing facilities. The client deeply appreciated our manufacturing shop floor expertise and our engineering mindset. This win embodies the convergence of physical and digital worlds and how LTI is uniquely positioned to take advantage in this new world order. Q2 marked the 3rd consecutive quarter for us winning net new TCV in excess of $50 million. Now let me share with you two marquee new logos that we have opened in Q2. We won a hard-fought digital engagement with a global Fortune life sciences company. The customer selected LTI as a strategic partner in its robotic process automation journey, leveraging UiPath as its automation platform and SAP as the core business process system. Similarly, we won a new logo, Fortune 100 Energy logo, to automate the client's finance processes, leveraging Automation Anywhere. With the addition of these two new logos, we now serve 61 global Fortune 500 companies. On client mining, our growth momentum in top 20 accounts have been strengthened by the success of our client mining programs like Minecraft and ADIA, which is Analytics and Digital in Every Account. This is evident in the growth beyond top 20 customers punching above company average and acceleration in share of digital service lines that I elaborated earlier. Let me now give you the growth statistics and color on each of our key verticals. Before I begin, I would encourage you to look at the constant currency revenue growth figures for different revenue cuts. The cross currency has been very volatile in last quarter, and Q-on-Q growth in USD terms has masked the underlying business momentum in some cases. Let me begin with BFS. Revenue growth was down 0.9% quarter-on-quarter. Based on Q2 results and our visibility on the book of business, I want to reiterate that BFS is on track to have a record year in FY19. The vertical has grown quarter-on-quarter in constant currency terms, and this sequential performance has come after 4 consecutive quarters of good growth overall. What do we see as driving growth for us? We continue to see expansion of tech spending in this sector across multiple areas. Technology-led operations is a big business driver for large banks, and we are also witnessing APIification of the application landscape to drive simplicity. Insurance vertical grew by 0.5% sequentially in Q2. We need to work on accelerating the growth in this vertical, and you would see some more focused efforts from us on that. We have a sequential growth of 0.6 in manufacturing vertical. Cloud adoption is now mainstream, and we are witnessing a major acceleration in ERP modernization initiatives. In Q2, a leading designer and manufacturer of mass transport systems engaged with LTI for transforming its operations, accelerating time to market, and digitizing internal processes using S/4HANA. For energy and utility vertical, it registered a 8.4% growth quarterly. The commodity prices have recovered well and oil companies are reporting strong financial performance. We continue to see the signs of industry spending opening up. While spending is recovering, it is mixed with some caution as energy clients wish to keep the cost structures lean. CPG retail and pharma, this vertical continues to grow to power our growth with an outstanding 15% quarter-on-quarter growth. With clear focus on differentiation, digital solutions, we continue to win new business in this segment. The large deal win that we have announced in Q1 and Q2 are also from this segment. As highlighted in my opening remarks, we opened a global Fortune 500 life sciences logo as well in Q2. There are umpteen ways to see life science companies transforming themselves, whether it's connected supply chain, raising bar on manufacturing quality, and crunching drug research cycles. Our strategy for life sciences vertical is to focus on this change opportunity. High-tech and media vertical reported a 1.8% quarterly growth after double-digit sequential growth last quarter. This segment continues to demonstrate rapid growth, and we envisage this to continue through the course of this year. Our growth in this segment stems from our focus on building platforms, data and intelligence systems, and cloud-native technologies. In Q2, an American broadcaster selected us for its enterprise-wide CRM consolidation, design, and deployment of Salesforce platform. When we talk about outlook and in summary, we continue to execute diligently to deliver on our ambition to be the company in the top quartile of growth. We have had 2 excellent quarters so far, and I have no doubt that LTI shall deliver another year of industry-leading performance in FY19. Let me now hand over to Ashok to share the financial highlights of the quarter.
Thank you, Sanjay. Hello, everyone, and thank you for joining this call. Let me take you through the financial high points for the quarter, starting with the revenue numbers. In Q2 FY19, our revenues at $328.5 million grew 2.7% quarter-on-quarter and 21.4% YOY. The corresponding constant currency growth was 3.5% quarter-on-quarter and 22.9% YOY. Reported INR revenue of 23,312 million was up 8.1% quarter-on-quarter and 33.1% YOY. The rupee top line growth was aided by sharp INR depreciation during the quarter. Now looking at profitability, the EBIT for the quarter was INR 4,424 million, which grew 16.1% sequentially and 74.4% on YOY basis. EBIT margin for Q2 stood at 19% versus 17.7% in Q1. Operational efficiencies, lower visa cost, and tailwind from INR depreciation during Q2 helped us expand our margins by 130 basis points sequentially. This was achieved after absorbing the annual wage hike effective July 1st. Reported profit after tax for Q2 stood at INR 4,003 million, up 10.9% quarter-on-quarter and 46.7% YOY. This implies PAT margin of 17.2% versus 16.8% in Q1. Given the depreciating currency environment, we saw a lower hedge gain compared to Q1, resulting into EBIT margin gain moderating to 40 basis point sequential improvement at PAT level. Now moving on to the employee metrics, utilization has improved from 79.7% last quarter to 80.4% in Q2, including trainees, and 82.3% as compared to 81.2% last quarter without trainees. We continue to grow our strength, and our net additions during Q2 were 1,264. The total manpower now stood at 26,414, and production associates were at 94.4% of the workforce. For the quarter, attrition inched up slightly to 15.3% as against 15.1% last quarter. Now moving on to Forex and hedge book position. Our cash flow hedge book as at 30th September stood at $1020 million versus $924 million as on 30th June. while the on-balance sheet hedges stood at $114 million versus $140 million last quarter. We continue to execute our hedging strategy consistently. This quarter, the effective tax rate was 25.4% versus 25.5% in Q1. Now, moving on to the DSO, cash flow, and working capital. As stated last time, during Q2, certain large programs achieved milestones and we invoiced them to the clients, resulting into significant reduction in unbilled revenue. Our overall DSO, billed as well as unbilled, registered 5 days improvement compared to Q1. However, the billed DSO at the end of Q2 stood at 75 days, up 2 days quarter-on-quarter. DSO including unbilled was at 108 days, down from 113 days in Q1, helping us deliver a significant improvement in our working capital situation. The net working capital stood at 21.3% of revenue, an improvement of 2.2% over the last quarter. All these efforts resulted into a marked improvement in our cash flow this quarter. The net cash flow from operations was INR 3,864 million, which was at 96.5% conversion of the net income. This was despite the fact that our annual incentives payments were made in Q2 like every other year, putting additional pressure on operating cash flow. We closed the quarter with cash and liquid investment at INR 17,160 million. EPS for the quarter was INR 23.14 per share, while diluted EPS stood at 22.60 per share. EPS on last 12 months basis stood at INR 75.9 per share as on September 18. You would have also noticed that the company has declared an interim dividend of INR 12.5 rupees per equity share, which approximately translates to 35% payout of the first half yearly profit. Now with this, I would like to open the floor for questions.
Thank you, sir. Shall we open the forum for questions, sir?
Yes, please.
Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star and 1. First question is from Nitin Padmanabhan from Investec Capital. Please go ahead.
Hey, hi, good morning. Thanks for the opportunity. Sanjay, just a couple of questions on growth and basically what you're seeing on the client side and also the supply side of things. First is, in conversations with a lot of our manufacturing clients, now do you see any worries in terms of their ability to spend going forward in the context of the trade wars and the consequent impact on their margins and earnings? The second question is, quite a few companies, your peers, have been talking about supply side issues sort of hurting their ability to execute. How do you see that playing out? Because when I look at our own utilization rates, it seems to be at an all-time high. And finally, you have always spoken about reinvesting incremental margins, and with margins sort of having such a strong pull through this quarter, how should we look at margins going forward?
Okay. Nitin, as always, you have asked 3 questions, and I will go one by one and try to answer them. Obviously, when you look at manufacturing customers and whether we are seeing them curtail any spend because of trade wars, honestly speaking, when we talk to our customers, we have really not seen any of that so far. I also saw the release that Caterpillar and 3M gave out that they are getting affected, but on the ground, when we look at the spend patterns of our manufacturing customers, we have not seen any customers having a cut down on their IT budgets. Again, I say, as far as you have solutions which can help them either cut cost or improve their coverage for customers and help them in the revenue line, they will find money. On the supply side issues, you look at us adding around 1,264 net new additions for Q2. And where we sit today, we will continue to add more people. Look, it's always been a challenge to get talent in this industry 30 years back. It's been a challenge last year, and obviously as the market heats up, this challenge will continue. But where we are with the on-site ratios that we have, obviously India has a large pool of talent. We just need to find the right talent, and we continue to grow there. So while there would be challenges, but they are no different from the past, and we just have to be innovative as we go along and keep adding people. We are confident that we'll keep adding people in times to come as well. On your third question on margin outlook and investing back into the business, you've got to see us as a growth-led company, and we will continue to do that with a sharp eye on the margin. Now, the margin, we were very pleased with our superior execution in this quarter that added to the INR depreciation benefit. Our actual margin delivery in the last 2 years has been better than guidance, and we hope to maintain that track record in FY19 as well.
Sure, great. Thanks a ton, Sanjay, and all the best.
Thank you.
Thank you very much. Next question is from the line of Sandeep Shah from CGS-CIMB. Please go ahead.
Yeah, thanks for the opportunity and congrats on a good execution. Just in terms of the overall, if I look at the net addition, so Sanjay, just wanted to understand that it has been linear with the volume growth as a whole. Just wanted to believe that most of the mid-cap companies have also started seeing some automation benefits as a whole, where the employee growth is lagging the overall volume growth as a whole. So do you believe for LTI also automation could be a big margin lever going forward, and when it will start getting into numbers where the net addition or the employee growth is lagging the revenue growth or a volume growth?
So there are quarters, if you look at a 4 quarters, there will be some quarters where there is a revenue, is at a higher clip than the volume, and there are some quarters where the volume is at higher. Automation, artificial intelligence, cognitive are areas for customer, for us to win more, bring value to our customers, and be competitive in the marketplace. And we have been doing that in a very, very meaningful way. So we want, so this is where when you guys ask us on whether there is a lot of price discussions with the customer or customers asking on, do we have a discount because of rupee depreciation? None of that is as important as the benefit that can come from automation, artificial intelligence, and cognitive work. And that is the focus for the company. That is where we have invested tremendously. That is the value we are able to bring. And that is what is leading to probably a superior growth that you see from us.
Thanks. And second, just a follow-up on the supply side issues. I think for LTI versus other mid-caps, there is a one strong trend is most of our growth has been coming through offshore leverage rather than some of the other mid-caps depending more on the on-site leverage. Do you believe this trend will change where on-site dependence could be higher for the growth, which can lead to a bit of a supply side issues which are especially coming on the on-site efforts?
No, I don't think, Sandeep. Look, we will continue to be range-bound at on-site. Some quarters will go up a little bit, but our efforts are always to do as much work as we can do in offshore. Use all kinds of technologies that are available to do that. And we will focus, and that does not mean that we have not added people in on-site as well, right? So we have been adding strongly at on-site as well, and we will continue to grow on both sides. But our focus will always be to increase offshore if we can.
Okay. Just few bookkeeping questions. If I look at the realized pricing in this quarter looks very weak in terms of the offshore. So how to read that? Is there any mix change in terms of SI-based revenues getting down that is leading to this kind of a decline? And second, Ashok, can you help us in terms of if the rupee spot rate continues at 73.5, then what could be one should model in terms of the hedges in the next half as well as FY 2020 going forward, because the translation gain may not be that big in the coming quarters.
Yeah, so Sandeep, as far as offshore thing which you are noticing in rate realization, this is basically large deal going through transition. And also there is some currency impact because this is realization is reported in dollar or you calculate, but INR is giving less dollar. So both these combined, the large deals which announced in the previously, they are going through transition. The second question which you asked about FX impact, yes, if currency stays where it is at 73.5, you will see revaluation gains of receivable going down, and hedge book also not adding too much to that line. So yes, they will come down sharply for the next 2 quarters.
Okay. And Ashok, is it fair to say, looking at the current new hedges, there is a possibility that FY 2020 we may have a favorable hedges looking at the current spot rates?
So you see, if you would have looked at that, we were at 924 million and now we are at 1020 million. So we added roughly 100 million during this quarter. So of course we will continue to do that work. So and now we are selling at 74 also, 73 also. So that's the consistency part of it. And they will be in gain when we come to the next year, assuming that rupee will not, rupee has done its sharp depreciation course already. So that will continue, and you will see some gains. But yeah, the previous hedges may be some loss. So it will be a mix of that. But if currency stays here, gain would be slightly lower. Gain line will be slightly lower going forward.
And if I can squeeze last question, Sanjay, just wanted to understand, by this time of last couple of years, you had a fair visibility about the growth of the next year. So what I'm asking is FY 2020. So do you believe this time the scenario is slightly more cautious looking at the macro issues through tariff and the Brexit, or you believe no, even FY 20 we can have a good growth year? I'm not asking for a number based on your order book, because generally you are confident by this time of the year.
Look, where I sit today, we have a healthy pipeline. 3 quarters of, every quarter announcing a large deal, which will start to ramp up in as we go now. Opening the kinds of logos that we are opening, uptick in our digital service lines across our verticals makes us optimistic about the future. I would like to leave it at that and say, you please remember that you have to consider us as a growth company. We want to be in the leader's quadrant of growth, if not be the leader, and that will continue in times to be.
Okay, thanks. Fair enough. All the best.
Thank you.
Thank you. The next question is from the line of Ashish Chopra from Motilal Oswal Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity. Sanjay, I just wanted to know from you in terms of the visibility over the near term in BFS in particular. So while the momentum of the last 4 quarters actually ensures that you will end up with a very, very robust year in terms of growth, but sequentially, do you see this kind of comeback after having maybe cooled off in this quarter, or do you see the furloughs and the seasonality kind of weighing on BFS if we were to look at it quarter over quarter?
Short answer, yes. It will grow. It will continue the momentum of growth in subsequent quarters as well.
Okay. And should I also assume that to be the case for the company overall, despite what is usually a lean season?
Because of the wins that we have announced, short answer, yes.
Okay. That's helpful, Sanjay. All the best.
Thank you, Ashish.
Thank you very much. A reminder to the participants, please enter star and 1 to ask a question. Next question is from the line of Harish Kumar Gupta, an individual investor. Please go ahead.
Yeah, sir, I have a couple of questions. One is in this quarter, salary hike is included or not? And secondly, how much percentage of revenue we are having as a recurring revenue?
First question was clear, which I am answering, and then you can repeat your second question. Yes, salary hike has been included in this quarter. Our cycle is always from 1st July, and we have done the same thing. The second question, if you can repeat, Harish.
How much our revenue is recurring revenue?
So it's not changed much. I think about 95% is the repeat business. That's the trend, 95-96% is a repeat business for us.
Oh, okay. Thanks a lot, and congratulations for the good quarterly result.
Thank you, sir.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. Next question is from the line of Arjun Asher from Envision Capital. Please go ahead.
Do we have any new initiatives to enhance the company's capabilities and skill sets, and what's really happening on the technology frontier right now?
Wow, that is a big question, man. Okay, you got me by surprise. So new initiatives and capabilities.
New initiatives which are happening to develop your capabilities and skill sets. And secondly, what's happening on the technology frontier in the industry? What is the next big thing, or on the existing things, what's the new dimension currently?
Okay. So look, the two initiatives that we run, Minecraft and Area, Analytics and Digital in Every Account, are very wide and all pervasive, and they keep including all the new technologies that are coming into place within the organization, within the industry and the world over as they accelerate. We keep adopting and bringing them to our customers. And that's what has been driving the growth for the company, and that's what is visible in the new kind of business that's gone up from 34% to 37% of our business. One of the things which is very talked about is what one does in the areas of blockchain, for example. We have done so many programs in blockchains, from trade finance, moving Cilium hubs for customers, and in place of doing manual checks on the various ports for the quality to be in place, and moving paper to be put on blockchain and doing it, or working on a national identity using a blockchain and a European customer, or helping a customer go into an adjacency of business and helping them do go and address the media houses. There are use cases on micropayments that we are working with the customer. So there are many things but blockchain is not all. There is additive manufacturing. There are newer ways of driving operational efficiencies. It's all about, at the end of the day, doing four things, right? One, how do you help your customers reach into adjacent businesses, right? A payments company getting into a business of going and selling into micropayments on media houses, or enabling revenue growth through new technologies that are available, or helping customers reach out to their end customers where it was not possible. For example, you buy from retailers, not from a CPG, consumer product companies. But how do you help consumer product companies know better about you and I through the technologies that exist today, maybe chatbots, for example? And the last and the big one is, how do you use newer technologies, IoT, and God knows all kinds of analytics, whereby you are driving operational efficiencies and helping them really drive up productivity improvement through man and machine talking to one another. So these are many initiatives that continue to work across. What is very relevant is that in the past, when customers used to hire for or outsource for scale, now today the customers do that for expertise. And if one has an expertise, size is not a matter, and you can compete with the biggest and the largest companies in the world because you have built expertise on those areas. Important thing, as always, is to focus on fewer verticals for us, for a company of our size, so that we can bring these technologies to those verticals and help solve their business problems. That's the focus for us as a company.
Okay. And recently there was some news flow regarding the H-1B visa thing where they are tinkering with some very basic definitions of employer-employee relationship and all that. So do you think do you fear some kind of a fundamental shift, or is it just some incremental tweaks which will happen to the H-1B program? What is your reading of it?
See, very frankly, I don't know, Arjun. I don't think the data is out yet. It's going to be published, I think, in the Q1 of January of 2019. We'll have to wait and see. But the global mobility overall is something that everyone has been watching for the last couple of years. We obviously will get impacted like everybody else, but our impact will be a little lower simply because we have lower on-site percentages. But over the last couple of years, we have also been looking at how do we hire more people, how do we, both laterals and freshers, and so on and so forth. But yes, we'll have to wait and see what happens and how do we innovate and continue to push the frontiers to do more offshore or find new ways of hiring talent locally.
Okay, so how big is technology an impediment to moving offshore even more than currently for the industry?
Look, different companies operate at different percentages. We are operating at 22 or 21.5 or something like that. You should look at the fact sheet to know the exact numbers. I might be wrong. Please look at the fact sheet. But around that, and there are companies which go at around 30%, right? So we obviously have a benefit of lesser percentage of people. But there are fundamental few things that one tries to do. Use technologies like video conferencing. There are technologies which help people collaborate between different locations and develop an agile and DevOps model. And also, I think the flexibility needs to be improved for Indian, technology people, whereby I think we will, in due course of time, have to work in shifts, even in IT, whereby we can actually have an overlap with the customers in varying time zones. Europe is a little easier, but even in US, we have to have an overlap on time, and that change will help us to do more offshore. These are some of the ideas that we have been playing with in the last couple of years.
Thanks a lot, sir. That was very interesting.
No problem.
Thank you. Next question is from the line of Apurva Prasad from HDFC Securities. Please go ahead.
Hi, thanks for taking my question. Sanjay, your outlook on the top accounts seems to have decelerated slightly. It's coming back on a high base, but if you can just throw some light on top 5 or top 11 to 20 or top 20.
I think you've got to look at constant currency numbers. There are accounts in top 10. There are more accounts in top 5. There are more accounts in top 10, and there are even more accounts in top 20, which are Europe or which have been affected by cross-currency movements, right? So that is an important aspect. Top accounts are all growing. We don't see any problems with any of them, and we're confident about them in times to come.
So would constant currency growth rates would be similar to company average for the quarter, the top accounts?
That I will ask Ashok to comment.
Yeah, they are close to the quarter, but you should also notice that beyond top 20 accounts are also kicking and supporting growth in a big manner. So while we are very confident about growth of top 20 accounts, we equally want the other accounts also to accelerate their growth, which is happening. So we are quite satisfied with that kind of thing happening.
Sure. And Sanjay, also on Europe, so constant currency seems to have come off slightly. So anything out there that you want to highlight?
No, I think we have to grow even more. So Sudhir is here on the call, and we keep talking about how do we grow more in Europe. There are a few deals that we are chasing, some large deals we are chasing, but a lot more opportunities for us to tap into.
Okay, thanks and all the best.
Thank you, Apurva.
Thank you. Next question is from the line of Rahul Jain from MK Global. Please go ahead.
Yeah, hi Sanjay.
Hello.
That's on good quarter. You shared the data that we have 61 Fortune 500 accounts with us. And if I look at that, we have this 25 accounts with 10 million plus revenue. So we have around 35 odd accounts which are giving, anywhere between $1 million or 5 kind of a run rate. So how you see this as a opportunity, given that some of these clients must be big spender on IT?
Absolutely an opportunity, Rahul. Some cases, you obviously see that there are lots of accounts where a lot can be done because their IT spends at times will be higher. Obviously, we prioritize them and say, look, this quarter, these are the few accounts that we want to, invest extra. Whether it's in changing, account manager or delivery partner or a consulting partner. And but overall, we see this as a great opportunity. Some of them also have opened, if you really look at it, in the last 4 quarters, right? Quite a few of them have been opened in the last 4 quarters, and in times to come, you will see them ramping up. But that is the future for us now.
Right. So what is a basic range? Very difficult to define, I believe, but a good run rate, you would say, for any large account from a spending perspective, that what is the ballpark number one would like to achieve where one can say we have done good with a particular account?
Very difficult question to answer. We would like to be very relevant in that account. Different accounts have different situations with them. Be in their IT spend for a banking customer in Fortune 100, Fortune 500 will be far higher than a manufacturing company in Fortune 500. An oil and gas company, given the volatility that they have seen, spends very, very different. They have different priorities, and in a lot of cases, some of them are very, very cluttered. So you make your move in through niche programs where, we are very differentiated, for example, data. But the intention is always to keep mining these large accounts and becoming more and more relevant. And sometimes it takes a few quarters, sometimes it takes a few years, and sometimes a little longer. But you just cannot let go of these 61 Fortune 500 customers, because sometime in their journeys, you will have a great opportunity to be even more relevant.
And given the landscape of the vendors pool in these accounts, we have seen a 20 million bucket is where we have scaled up very well in last 2-3 years. So is that a number where you would be more, realistic in a near-term perspective, that a lot of this 5 million, 10 million can become 20 million, and few of them may go to higher categories. But 20 million is that number which can see the biggest contribution from an addition perspective.
From our ability to serve our customer, right? We can serve our customer. Today we have customers approaching 200, right? So we can go from, our intention is always to be more relevant for our customer, take $1 million, first take an account to $1 million, then take an account to $5 million, and keep pushing the boundaries. I don't think we ever think of any of our customers to be stopping at $20 million. That will be very short-sighted.
Another question, if I see some of your service line like ADM, testing are growing at some 10-12% from a trailing 12-month perspective, and I assume that the growth rate for the service line would be a very small number. So how difficult it is to sustain this number, and if these are the number which we can continue, how much stress it would put to some of the other segments which are growing 30%, because to sustain those numbers become even difficult a challenge.
Look, even ADM has grown year on year at 12%. Enterprise Solutions grown at 27% in Q2. Obviously, analytics is growing very, very fast at 35%. Enterprise integration and mobility, as things go through APIs, is growing at 40-odd%. So I think there are opportunities like core modernization, core application redev, and a whole bunch of things that are there. And I think these new technologies sometimes are also in ADM. It's not like everything is getting done in ADM. Obviously, data is very hot. Right, so an enterprise integration and mobility is hot, Those will continue to grow at faster clip for the company, and rightfully so, because that is a reflection of you being relevant in the new technology landscape. But I think there are enough new digital SaaS, cloud stuff happening in infrastructure and enterprise solutions and EDM as well, right? PaaS as a service line.
So the point here is that if you clock 30% plus growth in mobility or analytics, which the spends are a significant tailwind. Everybody reports 20-30% kind of a growth in this space. The differentiation for us is not coming from these areas. The differentiation is coming that we are growing 10-20% in areas where people are actually seeing a decline or flat kind of a thing. So I think if we continue to be on that top quartile, the contribution from this old generation service line would be the key matrix. So how we sustain these numbers, given that the underlying growth itself is too weak.
No, look, I think you're talking about differentiation from I think, a revenue perspective and analyst perspective. For us, differentiation has to be in every service line. Testing itself has transformed itself to automated testing, regression testing, cloud-based testing, and a whole bunch of things. So you need to continue to invest in all service lines. And we are confident that we will be able to pull through on, enterprise solutions, ADM, and so on and so forth. We actually call ADM work as software engineering group now. It's all about new age technology, all about doing things in an agile and a cloud-based model using, PaaS platforms and so on and so forth. So there is great opportunities even in ADM area.
Right. That's it from my side. Thank you and best of luck.
Thank you, sir.
Thank you. Next question is from the line of Madhu Babu from Prabhudas Lilladher. Please go ahead.
Sir, our largest banking account is talking of a large transformational IT budget. However, for us, I think it appears that the top account has not grown this quarter. So what is the outlook on the top banking account?
Strong.
So we would be gaining share in this transformational spend?
I don't know what spend you're talking about. Accounts have been spending. They have not stopped spending, and we continue to take market share there.
Okay. And secondly on pharma, I think this is another quarter where we announced a deal. So if you see, just on the competition in these deals, because they are much larger scale players in this practice, whereas for us pharma is relatively a smaller practice. So what led to this deal win? Just can you talk about who were the competition in this deal?
I think everyone was there, global SIs and Indian pure plays. As I said, there are umpteen ways we see life sciences companies transforming themselves, whether it's connected supply chain, raising the bar on manufacturing quality and crunching drug research cycles. Our strategy in life sciences vertical is to focus on this change opportunity. When you specifically talk of this deal especially is in the area of physical and digital convergence, because this is where the customer is trying to transform. They were looking for a transformation partner which can help them embrace IoT and smart manufacturing across their global manufacturing facilities. This is where we have very, very strong capabilities.
And sir, lastly, just one question. If you see a company of similar scale, like let us say EPAM, which is almost like 27,000 employees, 1.6 billion, that is talking of a 23% kind of year-on-year constant currency growth organic. So we are at a similar sweet spot, a mid-cap vendor with scale. So do we see our growth accelerating to like over the 20% and almost at par with EPAM kind of growth rates? And if not, what is leading to this difference between us and EPAM?
I think I want to be relevant. I want to be in the leaders quadrant in the ecosystem that we operate in. I'm not a full student of EPAM and what they do. Different companies and different on-site offshore ratios bring different revenue productivities to play. We are very confident of competing with any global player, any player coming from Eastern Europe or South America, including EPAM. There are enough examples where we have competed against them and won. we want to be driving the growth for the company.
Okay, sir. Thanks.
Thank you. Next question is from the line of Ayush Abhijit from White Oak Capital. Please go ahead.
Yeah, hi, Sanjay. Congratulations. Great set of numbers. I wanted to get your thoughts on the cloud infrastructure management opportunity and LTI's positioning in this segment. I see that the IMS growth has been 30% YOY for you. So within this, how big would be the cloud IMS piece currently for you? And how do you see this hybrid/private cloud infra management playing out, given that local adoption now is kind of reached critical mass, expected to accelerate?
Ayush, your line is a little muffled. Can you say the question again? And we try to make it a little short because the line is a little bad.
Sure. So Sanjay, I was saying that just wanted to get your thoughts on the cloud infrastructure management opportunity and LTI's positioning right now in this segment. I see that the IMS growth for you has been 30% YOY. So within this IMS, how much of that is cloud versus traditional? And how do you see this opportunity playing out?
Okay, I'll take that. This is Sudhir. So from a IMS perspective, if you look at it, cloud is, in fact, all our clients are in the cloud, are using cloud to varying extent. So the cloud adoption is complete. Now, the real opportunity here is to help them in that adoption journey. So migration to the cloud and then the leverage of the cloud on an ongoing basis. So the emphasis moves from making, the previous emphasis infrastructure was mostly support, right? Just making sure environments were available. Now it's really about how do you best leverage what is available. Because that's why in the past, you built up a lot of infrastructure capacity which was underutilized. So here, now it's really about bringing agility through infrastructure. And that is that's the shift that we bring through the cloud. The second is, you're absolutely right about hybrid. We do operate in a hybrid environment with both private and public clouds together. And managing a hybrid environment essentially is to bring about a view where, a client actually is becoming more intelligent at the edge, which means that every person that is using technology is better equipped to take better decisions. So the cloud, the infra business has actually transformed from being support of data centers and, those kind of activities to really being about how do you leverage the cloud for agility, how do you actually combine public and your own private cloud infrastructure, public cloud infrastructure, and drive real intelligence at the edge. Those are the things that are driving our growth in infrastructure.
Okay. Yeah, great. Thanks.
Thank you very much. Next question comes from the line of Srinivas Rao from Deutsche Bank. Please go ahead.
Hi, thank you very much. One question I had was on the fact that the service lines you're growing are mostly digital, where the usual industry commentary has been that it's a lot more onshore driven, in some cases almost upwards of 70-80%. But your, so to say, effort makes sense to be still fairly favorably skewed offshore. How do you manage that, and how have you managed that? That's the first question. Second, ADM and the larger verticals obviously are seeing a slowdown in spending. Do you see that abating in the next, in the next 3 to 4 quarters, or that particular decline in spending, slow decline, will continue to happen for some more time? Thanks.
Agile DevOps work, Srinivas, we've been doing for many, many years now. And all these digital technologies, the work can be done from offshore, and we have shown that, and you see that reflected in the growth on the really digital service lines, right? So that's what is actually happening. There are, as you grow and do things, you refine your processes, you refine your ability to interact with the customers, you do a number of things to execute efficiently and effectively. That's number one. What was the second question? ADM service lines. Oh, actually, we are confident on all service lines, right? Though testing has been a little muted, overall in terms of year-on-year growth, but we are optimistic on pending on all service lines, and right now, even for testing, we are working, since we acquired Syncordis, how do we actually launch automated regression testing for Temenos platform. So there are good opportunities across the service lines, and including in infrastructure.
If I persist a bit, I mean, is it that the nature of the so-called digital bucket or the kind of projects which you're getting lend itself more to a more offshore mix versus what maybe other industry participants are talking about digital? Is that something which kind of differentiates you?
No, I don't think so. The way to look at this is customers are going to spend in doing what is right for them. And we have to compete in all of that. In areas we feel confident that we are able to do them effectively for our customers. Customers only want to do what is right by them, right? It's the same opportunities. And I said we are competing with EPAMs of the world, global SIs and Indian SIs. So we're competing in the same area. I don't know what specific areas that and what specificities that you're talking about, but I feel confident that we are able to execute from offshore on all the agile DevOps digital kind of engagements.
Yeah, just to build on what Sanjay was saying, see, digital also has a consulting, there's digital consulting and then there is execution. And what we have done well is our digital execution engine is on a global agile model. So you come to any of our offices, you'll see a very different way of working now. And I think it's actually one of our differentiators that we're able to execute large digital projects at scale from global locations.
Understood. This is helpful. One already asked this question on the cloud, both have private versus public. Are you seeing spends on on-premise IT or on-premise, cloud, private cloud actually flattening or falling? I mean, we know the public cloud spends are growing. So, any feedback on that would be helpful.
No, so if you see what is happening from a private cloud perspective is that all the existing infrastructure that. So if you see the history of this space, right, it moved from servers to virtualization to essentially a sort of on-demand infrastructure availability to a true cloud capability. And I think that journey will in the private cloud will continue. See, the private cloud is important because in certain cases, clients, whether it's for regulatory reasons, data reasons, IP reasons, GDPR reasons, there are several reasons why the private cloud will actually, it will continue to not just remain, I think it will actually continue to grow. Correct. And this is where, in fact, there are several partners that we work in our private cloud. The real convergence, the real sweet spot here is how do you use public and private together? That hybrid infrastructure leverage is what our clients are really looking to do in a much more effective manner, both from a speed and cost perspective. And I think that is something that we have done, the reason, even in my previous answer, we are saying we are seeing growth, because that convergence is something that we are doing very well with our clients.
Understood. Thank you so much. Very helpful.
Thank you. A reminder to the participants, to ask a question, please enter *1. Next question is from the line of Abhishek Bhandari from Macquarie. Please go ahead.
Yeah, hi, good afternoon, and congrats to the whole management for continued revenue growth.
Thank you, Abhishek.
Pleasure. I have two questions. What's the comfortable range on DSO you have internally, and what are the measures you're trying to do to get to over there?
One day. Okay, Abhishek, I will take this question, Ashok, here. We need to look at from various perspectives. The first step which we are trying to do that, our unbilled revenue we are trying to bring down, because that also blocks working capital and cash flow issue, because unbilled has a two-stage process where first it needs to be billed and then it needs to be collected. So I think that is the focus point. DSO has various external factors also, where you may have something in mind, but you get determined by what clients are trying to do and what your peers are competing with. Our right now target would be around 70-72 days. That is where we want to bring it, and from there on we will see what next, rather than fixing a number and then trying to chase that. We are currently 75. The next milestone is 72. But let me tell you, we are right now more focused on unbilled. So you will see some pressure on DSO because unbilled will get converted into DSO first. And the whole thing is finally cash flow. You know, whether you are having an operating cash flow which is solid enough and creating value for all the stakeholders.
Okay, thank you. My second question, if you see now the attrition levels for the whole industry has started inching upwards, by and large, given that probably there's an acceleration happening and employees are finding new opportunities. So are you also comfortable with the current number of 15.3, because that has been moving upwards steadily from June 17 low of 14.7? And what are some of the things you're trying to do here to keep it steady?
Well, there are a lot of initiatives. People are our primary assets in the company, and they work out every day, and we got to bring the guys back the next day morning. So there are many initiatives. We've got to be competitive. We've got to provide an environment for people to excel, people to learn, people to operate fearlessly, provide them an opportunity to grow. But the predominant driver for everyone, when I reflect on my own journey, is to work on a company which is growth-oriented. Because growth gives opportunities for people to play roles which are 1 or 2 levels above, right, what they've been hired for. First thing that we are doing is continue to be a growth company. Second is to provide an infrastructure, provide an ability for them to learn a lot with these changing times. Third thing is provide them an environment and a culture whereby they can fearlessly operate and take risks that are required and be innovative at the same time. And last but not the least, be competitive in all parameters, be it salary, be it policies, etc. that one has an operation. We launched a program called 1-2, which I think in what language is it? Zulu. In Zulu means I am because we are. It's all about creating. So there's got multiple initiatives within that, and which is all about people. So people are very important for us, and many things we are doing and focused on that.
That's good to hear. Thank you, and all the best for the remaining part of the year.
Thank you, sir.
Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments.
Thank you, everyone. Please note that we are hosting our 3rd annual Analyst Day in Mumbai on 12th December. Please mark your calendars. My entire team and I look forward to meeting you and interacting with you on that day. Good luck. God bless. See you soon.